My name is Nurul Azwani Huda binti Markom, ID number 2022909787. So let's start to the capital structure. In this presentation, we will discuss in detail topics in Chapter 3 and Chapter 4, which are capital structure. Capital structure is limits to debt use respectively. This presentation describes financial distress, agency cost of equity, picking all the theories, signaling hypotheses, and evaluates the factor that affects the capital structure and capital structure decision. Next, this presentation also encourages students to explore and have a better understanding of capital structure, the calculation, and gain more knowledge from other authentic success. Is capital structure? Capital structure refers to the way a company finances its business operation activities. It is the combination of debt and equity used by a company to finance its activities. Generally, it is the structure of financial claims that a company has against its asset and income. Debt and equity are the two components of a capital structure. Debt is generally defined as borrowed money that must be repaid with interest. It is usually provided by a bank or other financial institution and can come in the form of a loan or bond. Equity, on the other hand, it is the money provided by the company owners or shareholder. It is not repayable but comes with a return of investment. Capital structure can also be called a company leverage ratio. This is the ratio of debt to equity. It is a crucial measure of how efficiently a company uses its capital and can be used to assess its financial risk. Generally, companies with a higher leverage ratio are considered riskier as they rely more on higher leverage ratio are considered riskier as they are more reliant on debt to finance their operations. A company capital structure determines its overall financial health and stability. It can also have a significant impact on its stock price and share value. Companies should strive to maintain an optimal capital structure that allows them to achieve their financial objectives while minimizing risk. So, how to determine optimal capital structure? Determining optimal capital structure is an important part of running a successful business. It is the process of balancing a company liabilities, equity, and debt in order to maximize the value of the company while minimizing its risk. It is important to understand the various components of a company capital structure, as well as the benefits and risks of each type of capital. The first step in determining optimal capital structure is to analyze the company financial statement. This includes looking at the company's current asset and liabilities, as well as its current cash flow. The analysis should also include an assessment of the company's future cash flow prospect as well as any potential risks associated with its current capital structure. The second step is to determine the company ideal capital structure. This should take into account the company current and future cash flow, the risk associated with each type of capital, and the cost of capital. There are several models that can be used to determine the optimal capital structure for a company, such as the Miller-Modigliani model and the capital asset pricing model CAPM. The third step is to assess the company financial instrument to create its capital structure. This includes equity, debt, and hybrid instruments. It is important to consider the costs associated with each type of instrument. The fourth step is to assess the overall capital cost. This includes the cost of financing, debt, and equity. It is important to consider the overall cost of capital and the risk associated with each type of instrument. Finally, the company should assess the impact of its capital structure on its overall credit rating. This is important as it can affect the company's ability to access capital and can also impact its overall cost of capital. By following these steps, companies can determine their optimal capital structure and maximize the value of their business. It is very important to understand the various components of capital structure as well as the risks and benefits associated with each type of capital. By taking the time to properly assess the company's financials and create the optimal capital structure, companies can maximize their value and minimize their risk. Factor affect capital structure and capital structure decision. As we know, capital structure is an important factor that affects an organization's long-term success. It is the mix of debt and equity used to finance a company's operation. A company capital structure decision is an important one as it can have a significant impact on the company risk and return. A company capital structure decision is based on various factors. The most important factor is the cost of capital, which is the sum of the cost of debt and equity. Generally, the higher the cost of capital, the more the company has to pay for its capital and the less will have to invest in its operation. Another important factor is liquidity, which is the ability to convert assets into cash quickly. Companies that have more liquid assets are better able to manage their capital structure. Other factors that may influence capital structure decisions include the tax rate, which affect the cost of debt and equity, the company growth rate, and the company risk profile. The company risk profile is determined by factors such as the stability of its cash flows, the volatility of its earnings, and the nature of its operations. The company's capital structure decision should be based on careful consideration of all these factors. Capital structure decision making maximizes company returns on investment while minimizing capital structure risk. The company should also consider its own unique set of circumstances such as its size, industry, competitive environment when making capital structure decision. In conclusion, capital structure is an important factor that affects an organization's long-term success, and the company capital structure decision should be based on careful consideration of all factors, including the cost of capital, liquidity, tax rate, growth rate, and risk profile. Next, financial distress is a situation in which a person or company is unable to meet their financial obligations or pay their debts. It can be used by a variety of factors, including a decrease in income, an increase in expenses, or a combination of the two. In some cases, financial distress may be caused by external economic factors such as a recession or a pandemic. Financial distress can have serious consequences and can lead to bankruptcy or legal action. Consequently, it is important to take steps to avoid financial distress and to be prepared in case it does occur. This can include creating a budget, living within one's means, and creating an emergency fund. It is also important to be aware of one's right in case of a financial emergency and to seek out resources for help. Finally, it is important to remember that financial distress does not have to be a permanent situation. Move on to tax effect and financial cost distress are two issues that must be addressed when considering the financial health of any organization. Integration of these two issues is of paramount importance as it can help improve the organization financial health. Tax effect refer to the taxation of a company profit, income, and assets. The taxes levied on profits and income are determined by the level of profitability and the amount of income that the company has earned. Taxes on assets are determined by the value of asset and the amount of depreciation. Financial cost distress refers to the inability of a company to pay its bills. This can result from a variety of factors such as insufficient cash flow, lack of liquidity, or an unexpected increase in expenditures. It is important to address financial cost distress quickly and efficiently in order to avoid further damage to the organization's financial health. Integrating tax effects and financial cost distress is essential for ensuring the financial health of any organization. By integrating the two, organization can ensure that the taxation of profits and income are appropriate and that the financial costs are appropriate. The agency cost of equity is a concept that is used to explain the cost of equity capital as a result of conflict of interest between shareholders and corporate management. It is a type of agency cost which is a cost to the firm that arises from conflict between the objectives of the firm managers and the objective of the firm shareholder. The agency cost of equity occurs when the interests of management and shareholder are not aligned and managers the decision that benefit themselves at the expense of shareholder. For example, management might choose to invest in projects with a low expected return but a high risk in order to benefit themselves through higher salaries or bonuses. This decision would then result in a lower return for shareholder and therefore a higher agency cost of equity. Next, the pecking order theory is finance and economic theory that suggests that companies prioritize financing decisions based on the perceived level of risk associated with each type of financing. The pecking order theory states that companies use internal sources of financing first, such as retained earning, before turning to external sources of financing, such as debt and equity. The theory is based on the idea that managers prefer to avoid the cost and dilution of control associated with external financing sources. The pecking order theory was first proposed by Donaldson in 1961 and has been widely accepted. It is one of the most influential theories in corporate finance. The pecking order theory is based on the assumption that managers of firms are risk averse and prefer to use internal sources of financing when possible. This is because internal financing is less costly as it doesn't involve additional transaction costs or dilution of ownership. The pecking order theory has important implications for firms, especially small firms. Small firms often have limited access to external financing sources and tend to use internal sources of financing more than larger firms. Small firms are more likely to use debt financing when external sources of financing are available. The pecking order theory is not without its critics. Some argue that the theory oversimplifies the complexity of corporate financing decisions and ignores the role of capital structure in determining the cost of capital. Additionally, the pecking order theory does not take into account the impact of taxes and other factors that influence the cost of financing. Overall, the pecking order theory is an important and influential theory in corporate finance. The theory helps to explain the financing decision of firms and provides insight into the motivations of managers for utilizing internal sources of financing. Despite its critics, the pecking order theory remains an important concept in finance. Lastly, the scenario hypothesis is an idea in economy that suggests people can use certain action to communicate abilities, qualities, and intentions. Behavioral communication is based on the idea that communication is not just verbal, apply to the labor market, business decision, and even financial decision. This theory explains a wide range of economic behaviors. The Sinellian hypothesis theory has been applied to explain various types of economic behaviors such as the choice of job and labor market decisions. It is also used to explain how people use their financial resources to signal their abilities, intention, and qualities to others. For example, people may invest in stock to show their wealth, or they may borrow money from a bank to demonstrate their ability to repay their loan. Signaling hypothesis theory is a key concept in economics as it helps explain people decision and business decision. It is also used to understand investors' behavior and how they use their resources to communicate their intention and abilities. As such, it is a crucial concept to understand to make informed economic decision. So that's all for me. See you again. Bye.